That's 1930. All right, financial functions. Financial functions, if you look very carefully at this highlighted blue right, oh, I'll do it in blue. This highlighted blue right here, here is the chief financial officer. It says vice president of finance, which is a technical, but you end up with a CFO. This is also known as the chief financial officer. The chief financial officer is in charge of moving the money. And so you're going to have different sections here. Under treasurer, we see more traditional financial professionals. And under controllers, you're going to see more traditional accounting responsibilities. Okay, cost accounting, tax accounting, financial accounts manager. And here under financial, we'll do something more like capital budgeting. So somebody's in charge of actually creating what it's going to look like in the future. Somebody's going to be in charge of making sure that money is wherever it needs to be here under cash manager. Credit manager is somebody who's going to be in charge of bonds, not creating accounts payable, not necessarily paying accounts payable, but making sure that all that gets done. And then a financial exchange manager, and here's an international guy who looks at financial exchanges and what they look like over time. The double taxation problem. The double taxation problem, we'll talk about it in more detail later, but it basically works because the corporation gets taxed at, they have to pay a tax. It's going to get taxed at a corporate rate. Then whatever's left over in earnings, that's going to go to the shareholders. Shareholders then declare whatever they receive in earnings or dividends as income. Dividends are then declared by shareholders as incomes, and then they pay a tax on that income. So in essence, whenever a corporation makes money, you pay tax first here at the corporate tax rate, and then you as a shareholder will then pay tax again when you declare your dividends. That's the double taxation problem. And we'll talk about it in greater detail later, but just know that it's out there. S corporation, limited liability, we've talked about these a little bit already. There are ways to use these corporations to pass some tax issues. Growth of the stock market capitalization. Again, this is basically showing you the overall growth of the stock market, and this is important for financial professionals, not because the stock market itself is growing, but because as this grows, it signals that more and more companies are using equity as a strategic financial tool. So, as we just, one of the most basic, if not the first question that we should ask ourselves, one that we discuss in another micro lecture, is what should a financial manager try to maximize? This is the same as saying what is the first or primary goal for a financial professional? Should we try to maximize profit? Maximizing profit is, reflective of performance. It may or may not affect future performance. For example, you can take money out of operations today to try to maximize the money that's coming in, but it doesn't necessarily mean that you'll have money for, say, research and development, which then will create additional or greater profit in the future. So maximizing profit may or may not be the first professional's goal. Maximizing shareholder wealth is often the correct answer to this question, and some of this is debatable. But if I ask you the question in this class, what you should try to maximize, we're going to focus on trying to maximize shareholder wealth. What does that mean? It means that as money comes in and we subtract expenses, you know what? Let me do it with an income statement. We're going to get, you're going to get gross income that comes in, and then we're going to subtract expenses and a bunch of other stuff. And obviously it's a simplified sheet here. but we're eventually going to have earnings. And these earnings can go out to shareholders in terms of dividends, or they can get reinvested into the firm. And we call these uh, reinvestments, reinvested earnings, or retained capital, or retained earnings, earnings, retained earnings. And this money is going to go into creating other projects, which hopefully then increases our gross income. So here's where a financial professional, a CFO, has a decision to make. Do I pay out the money dividends in terms of shareholders, or do I reinvest that money into projects or research and development or hiring more people or whatever to try to get to increase my gross income? This is the core of the corporate financial manager's maximization problem. Should they focus on profits, meaning pay out dividends to shareholders, or should they focus on reinvestments in order to increase that gross income? And that's a really difficult decision to make, and it's one of the reasons why they get paid. So the focus on there are other stakeholders. We're not going to worry about that. That decision creates an agency problem. I'll do this in red because this is important. What is the agency problem? The agency problem is a conflict between the goals of a firm's owners and its managers. For example, if a CEO were to buy an airplane, it's a certain amount of money that goes into the use of the airplane by the CEO and its managers, and there's a certain amount of money that is not going to shareholders. Now, does a CEO really need an airplane? Not going to shareholders. Not going to shareholders. Oh no. Does he really need an airplane? I don't know. Maybe if he travels enough, that if his job requires him to travel enough, maybe it's a wealth creation tool. But often, at least perceptually, that is not a necessary expense by the majority of CEOs out in the marketplace, and that's a certain amount of money that should be that would otherwise go to increasing shareholders. The purchase of this airplane is at some cost. Let's say it's $2 million. This amount of money, I always forget that it does that. How does it do that? This amount of money is known as an agency cost. Okay. Agency cost. And so what is the value or the cost that is created by a conflict between the goals of a firm, owners, and its managers? It is an agency cost. And it does have a monetary value because these decisions take place in real life. And so there is some cost associated with that decision where the money would otherwise go to shareholders. Ethics, we'll talk about ethics as we go along. So, what is the primary, let's end here. What is the primary goal for financial managers? Financial managers should seek to maximize shareholder wealth. How do they do that is what we'll be discussing throughout the semester. Okay, I look forward to the next 14, 15 weeks. I hope you guys are getting off to a good start, and we'll see you soon.